We should set you up, Michael. You've been a skeptic on the whole streaming hype for a long time. Sort of missed part of the way up, but definitely right here on the way down with Netflix down more than 60%. Are you feeling any differently right now?
No, good morning. Good afternoon, Sarah. I think the problem with the model is it's so capital intensive, right? You need all this content to keep driving engagement. So I'm not feeling any more bullish today than I've been in the past couple of years. But what I find intriguing is you're starting to see other companies starting to acknowledge, the high cost of competing, like Warner Brothers Discovery's hinted about that. Disney's walked away from some sports rights in India. So maybe we're at the beginning of a sea change and how the companies are going to invest in streaming. But it's early days in that sea change.
In other words, we're going to see a lot less investment?
I think, in other words, in the next 1 or 2 years, people are going to rethink how much money they're going to invest in this space as they realize that the growth is slowing. So they need to find another way to drive profits, have to spend less. But I think, Sarah, again, I think we're in the first couple of innings of that. A year from now, it'll probably be more obvious that, there's less spending in the sector.
Well, Netflix does, to be fair, make money, right, Michael? And they have this grand plan of an ad-supported model. Does that change anything for you?
Yeah, so when we say make money, we look at cash flow. The company's going to do $1 billion on $30 billion of revenues, right? So that's not a great cash flow margin. The pivot to advertising, we think, is the right thing to do. It's smart. We see it as a creative potentially. We want to understand tomorrow how they're going to price the ad tier. How much lower will they bring the price down? But yeah, I agree with you. The move to advertising to us is smart. If they stop, investing as many films, they made 70, 80 films last year. That's probably like 30 to 40 too many. So there are things they can do to actually improve the free cash flow. When I say make money, it's free cash flow that I want to see really start to grow.
The expectation is low. It's down 68% so far this year, and they're expecting 2 million subscriber loss. But they did have a good, I don't know, just from the zeitgeist, it seemed like anecdotally Stranger Things was a hit. A lot of people watched. Could there be an upside surprise here, just given the setup and the fact that they had a hit?
Yeah, it's funny. We were originally going out with a higher number, so we stayed at the guidance of -2 million. But originally we thought, it's going to be worse than that. But Stranger Things came, and what they did really smartly was they kept 2 episodes for July, right? So people didn't churn June 30th because they wanted to watch the rest of the season, which I think is the beginning of a trend for them to realize, what HBO always realized, you need to spread it out over, 13, 14 weeks. So, yeah, I think that people our view is don't get too bearish on the subscriber print because of Stranger Things. Third quarter is interesting, and fourth quarter is going to be tougher. But what I've always done is I've stepped back and said, what's this company going to earn, either cash flow or EPS? So any volatility around subs, definitely moves the stock. But our issue has always been what's the earnings potential of this company, and that's why we're still neutral, because we think it's probably a $12 to $13 earnings company. 180 to 250 of earning is value. It's kind of how we see kind of fair value.